The story of Tyco passed through triumph, tragedy, and comedy. Now it ends in irony. The company was long the model of the acquisitive, illogical conglomerate. Decades of buying left it sprawling from healthcare to telecoms to electronics. In 2000, it had a market cap of $130 billion. Then it blew up in a scandal involving, among other things, a very expensive shower curtain, an ice statue that urinated vodka, and jail time. Fixing the mess over the last decade required splitting the company into three, and then splitting one of those thirds into three again. Now the last slice, still known by the original name, which sells fire safety and security systems, will be bought by Johnson Controls in a deal valuing Tyco's equity at $14.5 billion. The irony is that Johnson is, or was, an acquisitive, illogical conglomerate itself. It makes car batteries, a business it acquired, interior components for automobiles, acquired, and heating and cooling systems for buildings. It has already sold off its building management unit and plans to spin off the auto parts unit. So, the denouement of these two big merger unwinding stories is, what else? A merger. And there is at least superficial logic here. The same buildings that need heating and cooling systems also need fire and security systems. The customers are the same. The crucial questions are whether those customers want to buy both product lines from the same company and whether the two supply and distribution networks overlap enough to create real savings. A very aggressive operating cost savings target of $500 million, a quarter of Tyco's overhead costs last year, suggests management is optimistic about overlap. If that should prove a stretch, though, the companies did at least do the deal the right way, mostly in shares. The cash component of the deal was just big enough to ensure that Tyco shareholders would own over 40% of the combined company, allowing it to use Tyco's Irish tax domicile for another $150 million in annual savings. Paying more cash would have meant more debt for the combined company, and debt is even more dangerous to conglomerates than lack of logic. Rob Armstrong, Lex.